Hi there, this is Tenten. Today we'll be talking about an oil company that I'm still holding. Despite the potential recession in 2023, the oil price has been relatively strong recently. Why is this so? Due to the conflict between Russia and Ukraine, there's a decline in the amount of crude oil in the market. Moreover, Europe is heading towards the winter season. Therefore, there will be a constant rise in demand but a short supply of crude oil. The company that I'm talking about is Devon Energy. In today's video, we'll talk about how the company will fare as we head towards the winter season. Before we continue, please smash like button, and if you'd like to see more such videos, please subscribe to this channel. Firstly, we'll be talking about the business model of the company. Devon Energy, an independent energy company, primarily engaged in exploration, development, and production of oil, natural gas, and natural gas liquids in the US. It operates approximately 5,134 gross wells. Secondly, we'll be talking about the third quarter of the company. Devon builds on sales and earnings forecast when it reports its third quarter results, highlighting the oil and gas producer's capital discipline and ability to generate cash amidst a volatile oil market. The management continues to adhere to capital discipline and the prioritization of pre-share financial growth, steady and consistent exploration and production activity, free cash flow generation, and market-leading cash flow return to shareholders over production growth at any cost. As a result, Devon remains one of the best oil operators in the country. However, after the quarter, Devon shares fell driven by lower than expected production guidance for the fourth quarter, along with high capex spending estimates than analysts predicted. Operating cash flow for the quarter increased 32% year-over-year to $2.1 billion, roughly in line with analyst estimates of $2.18 billion. Free cash flow grew 31% annually, in line with forecasts. Capital expenditure came in at $690 million, which is at the lower end of management's $680 to $755 million guidance range and below the $727 million predicted by analysts. The strong cash flow realized in the third quarter allowed management to announce a fixed plus variable dividend of $4.35 a share. That is down from $1.55 per share in the prior quarter, as oil price skyrocketed in the second quarter in the wake of Russian invasion of Ukraine, before plummeting in the third. Devon did not aggressively make use of its $2 billion share repurchase program this quarter. The company bought back roughly $126 million worth of shares, putting its year-to-date total at $1.3 billion. Given this financial discipline, Devon expects to end the year with a net debt to EBITDA ratio of 0.5, down from 0.8 at the end of 2021. Next, we'll be looking at the fourth quarter guidance of the company. For the fourth quarter, management is targeting a 6% year-over-year increase in production of 640 to 660,000 barrels of oil equivalent a day. The 650,000 barrel a day midpoint is below annual estimates of about 660,000 barrels a day. Total capital expenditure are expected to be between $845 and $915 million, above the $783 million forecast by analysts. This guidance includes $120 million of equipment capital requirement related to the recent blow-on acquisition in the Eagles Ford and Western Basin. Free cash flow is expected to increase by more than 25% on an annual basis. Considering Devon's $1.17 billion of free cash flow in the fourth quarter last year, the target implies Devon will grow this figure to at least $1.46 billion, in line with the estimates. Thirdly, we'll be looking at some less known oil companies that have recently delivered their latest results. The first company that we're talking about is Pioneer Natural Resources. Pioneer Natural Resources climbed on the back of its solid third quarter results. The oil and gas producer also showed it's making good on promise to return excess cash to shareholders, checking the main box in most investment theses for the company. Pioneer results were solid considering the sharp drop in the oil price during the third quarter of this year. In the 3 months that ended September 30th, WTI crude fell by roughly 25%. Wall Street was well aware of that setup through, so it wasn't a surprise to find out Pioneer net income, free cash flow, and sales declined on a quarter-over-quarter basis. Pioneer continued to demonstrate its commitment to return the majority of its excess cash to shareholders via buybacks and dividends. That said, oil prices have rebounded by more than 10% since the start of October as a result of production cuts agreed by the OPEC, which provide a tailwind for Pioneers and other energy firms in the coming months. On top of its dividend, Pioneer also announced that it bought back $500 million worth of stocks during the third quarter at an average price of $218 per share. In the second quarter, by comparison, Pioneer also purchased $500 million in stocks at $235 per share on average. The company has $2.75 billion remaining on its current share repurchase authorization. Pioneer's third quarter buyback combined with the declared fourth quarter dividend payment add up to an annualized 12% total shareholder return according to the company. The second company that we'll be talking about is Halliburton. Halliburton reported better than expected results for the third quarter, boosting the long-term investment case in the energy stock. Halliburton served up another robust quarter on the back of increased demand in North America and internationally. With strong oil demand expected to persist and supply tight due to years of underinvestment, Halliburton should be able to further expand its profit margins and increase selling price. Halliburton management called the outlook strong and said oil and gas supplies will remain tight for the foreseeable future. The management team cited historical low inventory levels, production levels well below expectation, and temporary actions such as the largest ever strategic petroleum reserve release. At the same time, demand is resistant and should remain so according to management. Despite volatility in oil price, management remains confident that the strength seen in recent quarters will endure as only multiple years of increased investment in existing and new source of production will solve the short supply. If North America, management expects fourth quarter results in its completion and production division to increase by low to mid single digits with about 50 to 100 basis points of margin improvement. Sales from drilling and evaluation are expected to increase by low to mid single digits with a margin improvement of 75 to 125 basis points. At the same time, given the company's strong balance sheet and positive outlook, management said they are able to have greater flexibility to increase the cash we return to shareholders through dividends and buybacks. Moreover, Wells Fargo upgrades Halliburton to the equivalent of buy rating from Hold, altering a favored investment case that closely aligns with the investment rationale for owning the oilfield service company. In addition to the bullish rating adjustments, analysts at Wells Fargo have raised their price target on Halliburton shares to $52 from $33. Quote, macroeconomic headwinds may persist, but energy security and overall global oil and gas supply chains have created a sustained undersupply situation which should sustain commodity price and upstream investments, end quote, the analyst wrote in a research note. The Wells Fargo note came on the heel of Halliburton's reporting better than expected third quarter results. Quote, against tight supply, demand for oil and gas is strong and we believe it remains so, end quote, CEO Jim Miller said. Quote, while broader market volatility is clear, what we see in our business is a strong and global demand for equivalent and service, he added. The third company that we'll be talking about is Coterra. Coterra Energy saw its third quarter earnings beat, along with its hefty free cash flow and a raised dividend, solidify investors' investment case in the oil and gas producer. Coterra continued to return an oversized amount of free cash flow to shareholders, 74% in the third quarter to be exact. Coterra hiked its first plus variable dividend payout on a subsequent basis, supporting the second part of the investment thesis. The company was the only one out of three exploration and production holdings to do so this earnings season. Pioneer National and Devon Energy, by contrast, announced quarter-over-quarter decline in the payout due to falling oil price in third quarter. Based on recent commodity strips price, Coterra management expects free cash flow for the full year to be $3.9 billion compared with the estimates of $3.83 billion. Coterra also said its full-year capital budget is projected to be $1.7 billion, matching the high end of its prior guidance range of 1.6 to 1.7. Coterra said it will pay out a fixed plus variable dividend of 68 cents a share for last quarter, up from the 65 cents a share dividend in the second quarter. The company also spent $253 million in third quarter to repurchase 9.3 million shares at an average price of $27 a share. That is equal to about 24% of free cash flow. In the second quarter, 30% of Coterra's free cash flow went towards stock purchase, totaling $303 million. As of September 30th, the company has $510 million remaining on its $1.25 billion buyback authorization. Finally, we'll be talking about how I feel about the company. Despite the revenue being affected by dropping crude oil prices, the management team managed to keep its margin growth. Moreover, the company is benefiting from multiple tailwinds, such as the war between Russia and Ukraine and the sales of crude oil from strategic oil reserves. Therefore, despite the recent drop in crude oil prices, I feel the company is still undervalued. In conclusion, I will be still holding shares in the company. Moreover, if the stock price ever comes below $50 per share, I might be purchasing more shares, especially if it comes before the dividend cut-off date. There is no way I will sell any part of the stake in the company unless it somehow explodes above $90 and Russia stops attacking Ukraine. Therefore, I'll be buying up the company if it comes below my current basis. With that, thank you for a nice day. Goodbye.